Something is breaking in the silver market right now. A 22% crash in 2 hours just happened. Does JPMorgan have to do something with it? Well, here's the thing. This isn't just another random sell-off. I mean, you've seen silver crashes before, but this one's different. This time, the exact same pattern from last week is playing out again. The exact same desperate moves, the exact same suspicious timing. But what does this mean for silver investors? And why did Wyoming just ditch the banking system on the same day as this crash? Well, let me explain. Disclaimer. But first, let me give you the context of what actually happened, because the violence of this move is absolutely staggering. Silver crashed 22% in just 2 hours. That's a $17 drop in 120 minutes. We're talking about the kind of move that would make most assets collapse completely. The kind of selling pressure that should create panic across the entire market. The kind of crash that financial media immediately labels as the end of the bull run. And yet, something fascinating happened that tells you everything you need to know about who's really holding silver right now. Silver investors are down 14% after hours and just chuckling. Not panicking, not selling, not running for the exits, chuckling. Because we've seen this exact playbook before. We saw it 1 week ago when silver crashed 35% and JPMorgan covered at the exact bottom. We've seen these desperate smashdowns during thin trading hours designed to trigger stop losses and shake out weak hands. We've watched this manipulation game for years. And the fact that silver investors are laughing at the crash tells you something profound about the conviction level in this market right now. David Bateman said it perfectly, and this is crucial for understanding what's really happening here. He posted, "No asset investment besides gold and silver could be down 14% after hours and just make you chuckle. Bullion banks have reached the point of desperation." Now let that statement sink in for a moment. Bullion banks have reached the point of desperation. Not confidence, not strategic positioning. Desperation. These are institutions with unlimited access to paper contracts, with the ability to create selling pressure out of thin air, with decades of experience manipulating precious metals markets. And they're desperate. Why would they be desperate if they were winning? Why would they need to crash silver 22% in 2 hours if they had control of this market? The answer is simple, and it's the same answer we got last week. They're desperate because physical supply is breaking. They're desperate because 9 consecutive months of gains created a structural shift they can't reverse. They're desperate because industrial demand combined with investment demand is overwhelming their ability to suppress prices with paper manipulation. And here's where that word desperate becomes even more significant for silver investors. Last week, we saw desperation when silver crashed 35% and JPMorgan covered shorts at $75. This week, we see another 22% crash, taking us back down to $74. Same bullion banks getting desperate again? You tell me. Same pattern, same precision timing. Same massive selling during hours when retail investors can't react. Whether you believe it's JPMorgan specifically or not, what we're witnessing is desperation from institutions that are running out of options. And desperate players make mistakes. Desperate players reveal their hands. Desperate players show you exactly where they need price to go, which means they're showing you exactly where they don't want price to go. And that's up, way up. Because if they were comfortable with silver's trajectory, if they believed fundamentals supported lower prices, they wouldn't need these violent interventions. They would just let the market trade naturally. But they can't. Because natural trading in silver right now means significantly higher prices, driven by physical demand they cannot meet. But whether you believe it's them or not, whether you think JPMorgan is behind both crashes or if it's coincidence, what happened next reveals everything silver investors need to know. Because right as this crash is happening, right as silver is dropping 22% in 2 hours, Wyoming makes an announcement that should send chills down the spine of every bullion bank on the planet. The state of Wyoming just announced they're ditching JPMorgan completely and building their own precious metals vault. Read that again. A state government looked at the current banking system, looked at institutions like JPMorgan and said, "We're not trusting these banks with our gold and silver. They're not just moving their metals to a different bank. They're not just switching custodians within the existing system. They're building their own vault specifically to keep state-owned physical assets outside the banking system entirely." The Wyoming Reserve Opportunity Zone Fund Corporation in Casper just announced that the state of Wyoming has selected them to vault the state's physical precious metals holdings. Now let's talk about the timing here, because this is where things get suspicious. Silver crashes 22% on the same day Wyoming announces they're pulling precious metals out of the banking system. On the same day. The state treasurer's office spent months doing due diligence on this decision. Months evaluating security standards, governance structures, operational integrity. This wasn't a snap decision made in reaction to the crash. This was a calculated move that just happened to be announced at the exact moment silver is getting hammered in paper markets. What does Wyoming know that retail investors don't? What did they see in their due diligence process that made them say, we need our gold and silver completely outside the banking system? A state government with access to Federal Reserve data, with relationships throughout the financial industry, with resources to understand systemic risks that most people never see, looked at the current situation and decided the banking system cannot be trusted with physical precious metals. That's not a small statement. That's not routine portfolio management. That's a state government saying something's wrong in the banking system and we're getting our physical assets out before whatever's coming hits. The official press release gives us even more insight into why this matters for silver investors. They specifically note that relatively few U.S. states maintain physical precious metals holdings as part of their reserves. And among those that do, custody is often provided by federal institutions or out-of-state commercial vaulting providers. So Wyoming is breaking from the standard model. They're not doing what other states do. They're not trusting federal institutions. They're not using commercial vaulting providers that are part of the banking system. They're keeping state-owned physical assets within their borders in a facility specifically designed for precious metal storage. And the timing, coming right as we see another desperate crash attempt, reveals that institutions are getting nervous. Smart money is moving physical metals out of the system. Government entities are questioning whether banks can actually deliver physical metal when it's needed. This crash revealed that Wyoming, a state ranked first for business tax climate and as a sound money state, doesn't trust the current custodial framework for precious metals. And if a state government doesn't trust it, why should retail silver investors trust paper silver contracts held at the very banks that are allegedly desperate to suppress prices? But it gets even better for silver investors, because what this crash revealed isn't just about Wyoming protecting state assets. What this crash revealed is what's coming next week. And this is where the shorts are about to get absolutely destroyed. Because on the same day, silver crashes 22%. On the same day, Wyoming announces they're leaving the banking system. Vice President Vance drops this bombshell. The United States is going to establish a price floor system for critical minerals. Let me say that again. Price floors for critical minerals. And guess what silver is classified as? A critical mineral. The U.S. government is about to announce a system that puts a floor under silver prices. A floor that prevents prices from being manipulated below a certain level. A floor that protects domestic mining and ensures supply security. A floor that makes shorting silver one of the most dangerous trades on the planet. Now let's connect all these dots, because this is where the entire story comes together. That explains everything we've witnessed over the past 2 weeks. Last week, assuming it was JPMorgan, they covered massive shorts at $75. Exact bottom, surgical precision. This week, we crashed to $74. Another desperate smashdown, another attempt to break the bull market, another effort to trigger panic selling and shake out weak hands. And then next week, the U.S. government is going to announce price floors for critical minerals, including silver. Do you see what's happening here? The shorts, whether it's JPMorgan or other bullion banks, are making one final desperate attempt to cover positions and get out before the trap slams shut. They can see what's coming. They have access to policy discussions before public announcements. And they know that once price floors are established, their ability to manipulate silver lower evaporates completely. So they're creating these violent crashes to cover shorts, to exit positions, to get on the right side of the trade before the government literally makes it illegal to push silver below a certain price. This crash revealed the shorts are about to get trapped. Completely and totally trapped. Because think about what a price floor system means in practical terms for anyone short silver. Right now, if you're short silver, your best case scenario is that prices collapse back to $30 or $40 and you make massive profits on the way down. That's the dream trade for silver shorts. But if the government establishes a price floor, let's say at $70 or $80, suddenly your downside as a short is capped at that floor level, while your upside risk is unlimited. Silver can't go below the floor, but it can go to $150, $200, $300 on the upside. That's not a trade anymore. That's financial suicide. That's asymmetric risk that no rational trader would take. So anyone short silver right now has a very limited window to exit before price floors are announced, and they are stuck in positions with unlimited upside risk and capped downside profit potential. And here's where JPMorgan's timing from last week becomes even more significant. If it was them, and again we can't prove it, but the pattern is identical, they covered at $75, the exact bottom. They knew that was the floor. They knew physical demand wouldn't allow prices to go lower. They knew something was coming that would support prices. And now we know what they knew. Price floors for critical minerals, government policy that puts a hard bottom under silver. Whether it's JPMorgan specifically or other bullion banks seeing the same data, the smart money is covering shorts at these levels because they can see the trap forming. They can see that next week, his announcement is going to change the entire risk profile of being short silver. They can see that the manipulation game is ending, not because they lost control, but because government policy is about to make that control irrelevant. For silver investors, this is the moment we've been waiting for, not just for years, but for decades. We've watched silver get manipulated lower during every rally. We've seen massive short positions cap prices whenever momentum builds. We've documented the coordinated selling during thin trading hours designed to create the appearance of weakness. We've understood that a small number of institutions can move paper prices with derivative positions that have no connection to physical supply and demand. But what if all of that is about to end? What if government policy is about to eliminate the ability of banks to suppress silver prices below a certain level? What if the next crash attempt is legally prohibited by price floor regulations? That changes everything. That transforms silver from a manipulated market into a fundamentally driven market where supply, demand, and industrial usage actually determine price. Let me break down why this matters so much for your portfolio as a silver investor. First, price floors create asymmetric opportunity. If silver has a government-established floor at $70 or $80, your downside is limited to that level, while upside remains unlimited based on supply-demand fundamentals. That's the kind of risk-reward profile that attracts massive institutional capital. Second, price floors force short covering. Anyone short silver right now has to decide whether they want to hold those positions into a regulatory environment that caps their profit potential, while leaving them exposed to unlimited upside risk. The rational decision is to cover now, which creates buying pressure that pushes prices higher. Third, price floors validate the thesis that silver is undervalued and strategically important. When the government steps in to protect price levels, they're confirming that current prices don't reflect true value or national security interests. That brings in a whole new class of investors who view silver as a strategic asset rather than just a commodity. But there's something even bigger happening here that connects Wyoming's announcement to Vance's price floor comments to these desperate crash attempts. What we're witnessing is the end of the paper manipulation era in silver. For decades, physical silver markets and paper silver markets existed in separate universes. Physical buyers paid premiums over spot price to get actual metal. Paper traders moved prices with contracts that never resulted in physical delivery. The two markets influenced each other, but operated on different fundamentals. Physical was about supply and demand. Paper was about positioning and leverage, but that separation is breaking down. Wyoming moving metals outside the banking system shows that physical holders don't trust the paper system anymore. Price floors show that government policy is going to be based on physical metal value, not paper contract prices. These crashes show that the institutions controlling paper markets are desperate because physical reality is overwhelming their ability to suppress prices. And this is where silver investors need to focus on what really matters going forward. Physical metal, not paper contracts, not silver ETFs that may or may not have the metal they claim, not mining stocks that give you leverage but no actual silver, physical metal that you hold outside the banking system just like Wyoming is doing. Because what these crashes are revealing is that there's about to be a massive divergence between paper silver prices and physical silver availability. Paper markets can be manipulated down to any level the banks want in the short term. They can create selling pressure with derivatives. They can trigger stop losses with coordinated smashdowns. They can generate headlines about silver bubbles bursting, but they can't create physical silver. They can't make supply appear when it doesn't exist. They can't force industrial users to stop buying. They can't make investment demand disappear just because they crashed paper prices. So what does all of this mean for you as a silver investor heading into next week? First, expect the price floor announcement to create immediate upside pressure. Once the government confirms they're putting a floor under silver, shorts have to cover or face unlimited risk. That buying pressure, combined with existing physical demand, creates the setup for a violent move higher. Second, expect physical premiums to spike even harder than they did last week. Dealers are going to be overwhelmed. Premiums over spot are going to explode. If you want to add physical metal to your stack, you need to act before the price floor announcement makes everyone realize silver at $74 is an absolute gift. Third, understand that we might see one more desperate crash attempt before price floors are announced. If the shorts know their window is closing, if they know next week brings policy that traps them, they might try one final push lower to exit remaining positions. Don't let that shake you out. That's the final gift before the manipulation era ends. Fourth, remember what happened last week. Despite a 35% intraday crash, silver still closed January with its 9th consecutive monthly gain. 9 straight months of gains. The bull market didn't break. The trend remained intact. This week's 22% crash is the same playbook. It's violent. It's scary for people who don't understand what's happening. It creates headlines about silver collapsing. But it doesn't change the fundamentals. It doesn't create supply. It doesn't reduce industrial demand. It doesn't make the past 9 months disappear. All it does is create opportunity for people who understand the difference between paper price and physical value. But what is your opinion on this? Comment down below. If you are curious to find more, then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed the video, then turn on the notifications bell on this channel. Missing an important silver update might make you lose money, so don't risk it. Also, please share this video with as many people as possible. Let's get this news out there.